And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. Today, we have got an absolute jam-packed show. Today, we're going to be discussing so many of the things that have been going on within the financial world, the investment world, the political world, the interest rate world. Like, news is changing almost by the hour. Things are shifting and evolving right before our very eyes. It is a fascinating time to be alive. It's exciting. It's also kind of scary. And today we're going to be specifically honing in on comments that were recently made by the Fed Chair, Jerome Powell, in his presentation, his speech in Rhode Island just recently. You've probably heard the phrase deja vu. It's certainly something that we're pretty familiar with. It's a phenomenon that many of us have experienced. But when I heard his words in this presentation, man, it sent a chill right up my spine. It was so reminiscent of things that we got told as Americans, what Congress got told as, well, as the ruling class at the time in 1996 by none else than Alan Greenspan. What was it that Jerome Powell said? Well, you're going to have to stick around and wait to see what these words were that were so reminiscent and scary of 1996. Now, if you're brand new to today's program, I want to just say welcome to the program. If you've been maybe hunting around trying to find something that provides financial education, helps you in your financial and investment literacy, you're trying to get better prepared, you're trying to make good decisions for your retirement so that when you get to retirement, if you're not there already, that you can live the retirement of your dreams. You can feel that sense of ease where you're getting more income than what you need. In so many people's minds, the definition of a successful retirement is just that, having more income than what you need. Today's world is so focused on growth and quick gains, we tend to forget about the long game. We tend to forget that we could be living 20 or 25 or even 30 years. And so we have to ask ourselves, am I poised? Am I prepared? Am I investing the right way? Am I educating myself on the right things so that I can have that kind of a retirement? Well, if that's what you're looking for, you're in the right place. And I encourage you, get a copy of my book, The Capitalized Retirement. I also encourage you, go to our website, johnsonwim.com, where you can listen to past radio shows. You can watch YouTube videos that we post every single week, along with podcast videos. And there's an assortment of different financial white papers and resources that are there just for you and for your edification, for you to be able to learn and better understand what it takes to be a successful retiree in today's world. So Jerome Powell, he's been pretty much in the news every single day. And guess what? He's been front and center really since 2021. I want to go back in time with you. In 2021, we know that the market surged extremely high, extremely fast, breaking world record highs in record time. And why was that? Well, if we remember, the previous year was not great for Americans. It wasn't great for this nation. We had the pandemic. We sent folks home. We shut down the world, and our economic car got stalled in the middle of the freeway. Well, that's not good for anyone. It's certainly not good for our government. It's not good for us as a society. And so as a result, the Federal Reserve was called upon to do something and to do something quickly. Well, they did exactly that. They took interest rates and they dropped interest rates to zero. Now, let's think about this for just a moment. We know that when interest rates are low, certainly it helps us as Americans to be able to do more stuff. We can buy our cars for less interest when we finance them. We can build new homes and we can have a lower mortgage rate. If you're a business, you're going to borrow working capital like mad so that you can go ahead and do your research and your development. You're going to borrow that money so that you can have a merger or an acquisition, or you can go public. These are all things that happened in 2021, and it really fueled the absolute snot out of the market. The market zoomed upward and onward, and it was amazing. It was a great ride. For those of us that had our money in the market, we were absolutely astounded at what a reversal it was from 2020. We probably remember in March, where from February to March, the stock market in 2020 had nosedived 37% in 6 weeks. It was breathtaking. But in 2021, not only did we get all of our money back, but we were able to make gains on top of that. Now, that would have been nice had the market continued to surge. Would have been nice had the Federal Reserve kept interest rates low. But here's what happened. Because the interest rates were low, and because we did have supply chain shortages, we essentially had too many dollars chasing too few goods. And that is the definition of inflation. And so before you know it, at the end of the year, in 2021, we were dealing with, as Americans, inflation at nearly the rate of 10%. We were crying, we were screaming, we were yelling, we were demanding for prices to come down because we did not like what it did to our cost of living. And of course, we were just coming off from the heels of a pandemic. We were still licking our wounds. We were still feeling that nervousness. But the Federal Reserve, well, it got called upon again by Congress to do something and do something quickly. So what did the Federal Reserve do to bring inflation down? You've taken the car, which was stalled in the freeway. You've basically got it started. You've put some nitrous on this car. You've pushed the pedal to the metal, and now the car is careening down the interstate. And now Congress is calling for that car to slow down. Well, how do you get the car to slow down quickly without careening off the edge of that clover leaf? Well, the answer was simple. The Federal Reserve had to do the opposite of what the Federal Reserve did in 2021 to get the economy going. This time, over the course of the next 2 years, in 2022 and 2023, they took our interest rates and they drove those interest rates up 11 times. I remember being an advisor. I've been in this business for nearly 30 years. And I remember in 2018 when the Federal Reserve raised interest rates 4 times. And at that point, we were losing our minds as advisors and economists. We were thinking, what in the world is going on that the Federal Reserve would have the audacity to increase and drive up interest rates 4 times? Well, little did we know that in 2022 and 23, the Federal Reserve would do nearly 3 times that. And did it slow down the economy? Absolutely. You bet your buttons it did. And it created in the interim of time chaos. It created in the interim of time buying opportunities. It created in the interim of time a bunch of uncertainty. We really didn't know what to expect next. We didn't know if we were going to see these interest rates continue to climb and it was going to push us into a recession and off the cliff. And here we would see the swinging of the interest rates going all the way back to zero. It was so hard to navigate. And for Americans, for those of you that weren't you weren't retired yet, you were still investing, it was very difficult to navigate. But you did your very best. Now, fast forward, and by the end of 2024, the last quarter of 2024, we have our election. The market is up. But in December, all of a sudden, the Federal Reserve starts hinting that even though it had told us as Americans, as investors, that it was going to be cutting interest rates in 2025, now they're hinting that they're not going to. And even though they had given us a 50 basis point rate cut in October, a 25 basis rate cut in November, and then another one in December, well, you just simply don't make promises to the market and then not keep it. Now, to add insult upon injury, we all know that with the new president, the new administration, we had some very big political news, some very big economic news, and we had the introduction, the idea, the unveiling of the plan of tariffs. And this absolutely shook the market to its core. There was so many unknowns that the market didn't know what to do. The market had never fathomed numbers this big. When you're seeing a 100% tariff, you're seeing 1,000% tariff. What are you to make of information like that other than it was going to be the end of the world as we all knew it? Things were going to go sideways, and before you knew it, it was going to be the Dust Bowl, and it was going to be another Great Depression of 1929. Well, fortunately, that didn't happen. Fortunately, countries came to the table. Countries negotiated. President Trump has relented on some of his ideas that were quite, shall we say, objectionable. He has made deals. He has further clarified the rules and the regulations and the things that he wants to implement. He's made it very known that he wants to be fair and equitable, but he's not going to let the American economy take the brunt of unfairness from other countries that we trade with. Now, as much as that is admirable, off in the corner has been the Federal Reserve. In January and February and March and April and May and June and July and August, and finally in September. It took 9 months for the Federal Reserve to finally, shall we say, develop the courage to actually cut interest rates. It's quite funny when you think about what was said about the tariffs and the economy and how the economy was going to be utterly destroyed. How all of the talking heads and all of the news pundits said the tariffs were going to bring our economy to the brink of destruction. Today, we're seeing all of the reports like the Producer Price Index and the CPI. And guess what? It's almost as if the tariffs don't exist. Things are clipping along at a wonderful pace. The market's growing at ease, and the market's going up. We're hitting world record highs every single day. But now, fast forward to September 23rd, and Jerome Powell has a speech in Rhode Island. Now, what did he say that was so scary? Well, I'm going to do it to you again. You have to sit tight, wait for the second half, and we'll be right back to discuss what he said that was so scary. Sit tight. You're not going to want to miss this. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you? If you're just joining us, welcome to today's program. Now, for many of you, I left you with a bit of a cliffhanger. The first half of today's program, we discussed basically a rehashing of everything that has happened within our country and our economy and the stock market, really from 2020 until 2025. We talked about what happened with the stalling of the economy and then the surge of the stock market and the economy in 2021. And then all of a sudden, the inflation being absolutely beaten down by 11 interest rate increases by the Federal Reserve. Today, Federal Reserve is front and center in the news because after 9 months of going on a sabbatical, basically denying the market and the economy an interest rate cut, which so many had suggested was well overdue. When we look at our job numbers that were estimated at 75,000, it came in at 22,000. When we think about all of the slowing economic data lagging data that's coming in, we know economically that the Federal Reserve should have already cut interest rates. At least that's the opinion of many. But the Federal Reserve got together in September, and they cut interest rates by 0.25%. Now, I'm not one to kick the gift horse in the mouth. I felt like we needed to get 50 basis points, but we only got 25. But when we look at where the economy is going, when we look at what is happening with inflation, what we see is that the market is basically reflecting a very strong economy. The economic numbers that are coming out almost on a weekly basis is showing us that the market and the economy is very resilient. It's really no longer fussing over the tariffs. It's finally dealt with the idea that we're going to have the tariffs. We're going to continue to get better information about how they're going to affect certain countries and affect us and affect our supply chain. And then, of course, things are still being worked out. There's still negotiations and deals trying to be made with other countries. But that's not the point of today's radio show. Today, we want to go back and we want to look at what Jerome Powell that spooked the market. The day was September 23rd. He was giving a presentation in Rhode Island. And during this presentation, he made comments like, "There is no risk-free path." Well, you've probably heard that there's that old phrase, pick your poison. It's 6 of one and half a dozen of the other, right? It's kind of a darned if you do and darned if you don't. Well, the reality is that it wasn't just 1 or 2 or 3 or 4 phrases that kind of culminated within this presentation that Jerome Powell gave. He went on to say that there was two-sided risks. He went on to say that there was a challenging situation for the Federal Reserve because, after all, we had higher inflation and we had lower jobs, lower employment in our country. And all the while, this is what he said towards the end of his presentation, that equity prices were fairly highly valued. Now, I want you to think about that. He said that equity prices, that means stocks, that means mutual funds, that means index funds. He said that stocks or equities were fairly highly valued. Now, why did that spook the market? Why did the stock market have a bit of a sell-off? Because, well, let's go back in time. In fact, let's go back a long ways. Let's go back to December 5th of 1996, when we had the infamous economist testifying before Congress. His name was Alan Greenspan. And Alan Greenspan he was put down into history for coining this phrase, irrational exuberance. Now, everybody would like to probably be known as someone who's exuberant, someone who is excited, and they bring that charisma to the table. But irrationally exuberant? Well, I don't know about you, but that doesn't sound very good. So what is Jerome Powell saying? And is it something that we need to be paying attention to? Is this something that maybe is a bit of a scare tactic? Because, of course, we all kind of have been witnessing how Jerome Powell and President Trump seem to be at odds. It's pretty obvious. They need to get a room. They need to kiss and make up, but it's probably not going to happen. Well, I want to take you back in time, something that I have mentioned on this radio show a number of times, which is just very basic. It's basic math. It's basic analysis is something called the price to earnings ratio. And the price to earnings ratio is actually quite fun. It takes and allows a person like you and I to take big numbers and basically boil it down into something that's very simple to understand. It helps us to be able to look at a particular company stock and decide if it maybe is overvalued or if it's the right value or potentially if it's undervalued. But one of the things that I would encourage you as an investor, as a person preparing for retirement to do, is I would encourage you to look up the Shiller PE ratio. Shiller, spelled Shiller, ILLER. Now, why is this important? Well, this is not just a PE ratio. This is going a little bit further than a PE ratio because it's taking into account and it's indexing up for inflation. Some would say that it is one of the most accurate representations of a PE ratio that there is in modern society. Now, why is this important? Well, if we look at what the Shiller PE ratio is, and then we look at, okay, say the S&P 500. What's the mean? What's the middle? What's the average PE ratio, the Shiller ratio for the S&P 500? Well, the number is 16. So I want you to keep that in your mind. Now, right now, if we look at the S&P 500, the ratio has doubled. It is now sitting at 30.73. Okay, so it's an average of 16, but today it's more than double that. Now, what is that telling us? Well, first of all, let's go back to just a very simple example. Let's say that you wanted to buy an ice cream parlor and you went into this ice cream shop that you had always enjoyed and you had your eyes on it and you wanted to buy. You really wanted to own it because you just thought it was such a quaint, wonderful place. And you asked the owner, how much income, how much profit do you get to keep? And he said, well, about 100,000. And you said, boy, do I have a deal for you. I want to take and offer you $3 million for this ice cream parlor. Let me ask you, do you think he would accept the offer? If you said yes, I'm in agreement with you. I think he would. And you know what? Here's the deal. That's a PE ratio of 30. So if you wouldn't spend $3 million on an ice cream parlor that was only netting a profit of $100,000 per year, knowing and realizing mathematically you would have to scoop ice cream for 30 years before you would get your money back on this business deal, I want you to know that that's where the market is today. And here's the other thing. We need to look at where the market was at other points in time. For instance, if we go back to December of 2021, you remember how I said interest rates had gone to zero and the market zoomed onward and upward. Well, just before the market cracked in December of 2021, the PE ratio was at 35. Now, if we go back even further, let's think back to the day before 2007, 8, and 9. We think about the high of 2007. The market is now broken even with year 2000. We have gone through 7 years of 50% loss and 4 years of recovery to get back to where we were. We're all wiping our brows saying, phew, glad that's over. Well, in 2007, the PE ratio was at 24. We are 26% higher in today's market than the market was in 2007, just before the Great Crash and the Great Recession of 2007, 8, and 9. So what is Jerome Powell trying to suggest to us? Is he foreshadowing what's going on in the market? How have you been feeling about the risks that potentially you're being told to take by your financial advisor? Are you following the herd? Are you going through FOMO right now where you have the fear of missing out? You see, just because Jerome Powell makes a comment that says, hey, I feel like equities are fairly highly valued right now, that doesn't necessarily mean that the value of stocks is going to crash tomorrow. But we all know that a bubble can form. And it can form so slowly that we fail to realize that there's cracks in the wall of the balloon. And I want you to consider, are you to the age where you need to be mitigating your risk? Are you to the point where you need to pay better attention? You need someone to help you manage the risks that are within your own portfolio so that if something good occurs and the market continues to go up, you're able to take advantage of those gains. You're not sitting on the sidelines. You're not just watching the train go by, but you're actually benefiting from some of that growth. But at the same time, knowing that you have your downside covered, making certain that you're prioritizing the protection of your principal, the principal that is supposed to be relied upon for the rest of your retired life, whether you live 15 years, 20 years, 25, or maybe as long as 30. So, think about the words. Equities are fairly highly valued right now. Is this something that calls for you to begin implementing some caution, looking and analyzing, figuring out if you are at risk, too much at risk, and you're falling victim to the headlines and all of the hype? I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.